Irina said, right? Irina Verim is your class teacher, and she wrote that her class will be next Wednesday, I think. Is this right? Are you here, guys?
Yep, sure.
Because maybe I just have empty names and nothing else. Yes, we will have all classes will start with a quiz. So the idea of the quiz is that you listen to the lecture and you come prepared, more or less prepared to the class. So you already know the material of the lecture, and you start with a quiz where usually the quizzes are very simple, and they follow. So the quiz, which will be on the first seminar, the first class next week, will cover the material of the last week and today. Mostly the today's material will be on the quiz. And after the quiz, then you will have time to discuss the quiz, to solve different, maybe difficult problems, difficult questions, to make sure that you understand everything correctly. And then you will have some time to solve some extra problems or discuss something depending on the topic. Regarding the online part, yes, that's a good question. You should already start watching the online lectures because like in maybe 3 weeks we'll have the test. The online lectures are not very long, but still you need to devote a couple of days to watch them, so it's better to start watching them now. But I will announce the date of the test, so I need to figure out myself when it's more convenient to have the test covering the online part, and then I will announce it in the Telegram chat in advance, of course. So please remind me. If I forget to tell you about the date of the test, then remind me. So I should announce the date maybe this week, okay, so that you have enough time, like a couple of weeks, to prepare. But definitely you may start watching the videos now. What else? Also, I have uploaded, you have seen in the chat, I have uploaded some slides which cover the textbook. So today we'll talk about exchange rate determination model. And this model is covered in your textbook by Krugman and Obstfeld. And here in the chat, I have uploaded the PDF file which contains the lecture notes which follow the chapter in the textbook. So I have my own lecture notes, so we will study on my own lecture notes, but you can also read those lecture notes because they're like a substitute for the textbook, but a shorter substitute for the textbook. So let me demonstrate my screen now. Can you see my screen?
Yes.
Okay, great. So let's start, guys. I think everyone has joined who wanted to join. So in the previous lecture, we had just very introductory material about exchange rates, currencies, and the Forex market. Today we start a new topic, the exchange rate determination. And as I said last time, we consider currencies actually as regular assets. So they're not much different. So we consider, when we want to price currencies, we consider them as assets. So this is called an asset approach to exchange rate determination. And basically the idea behind the asset approach is that we look at expected returns from this asset, and they will determine the price of this asset now. And the price of a currency is the current exchange rate, spot exchange rate. So today we will have some theoretical stuff, but very easy stuff. A quite easy model of exchange rate determination. So first of all, let's talk in general. When we consider foreign assets, and the demand for foreign assets depends on, as for other assets, depends on basically two characteristics: risks and returns, right? As in financial economics, these are the two main characteristics of any asset: the expected return and the risk. But for foreign assets, the expected return can be calculated using this formula. So again, this is a general formula for any foreign asset, not only currency, but any asset, like any foreign bond or foreign stock in general. So the expected return is calculated as the expected price of the foreign asset in the next period multiplied by the exchange rate in the next period, so here we use the direct exchange rate. So the price is in foreign currency, is expressed in the foreign currency, so we need to multiply it by the exchange rate, which is denominated in the domestic currency per unit of the foreign currency. And then as a result, we convert the foreign price into the domestic price. Then we need to subtract the current price of the foreign asset, again multiplied by the current exchange rate, and we divide it by the current price of the foreign asset. So basically, it's like the change of the price over one period from now t to the next period t plus 1. So the change in the price, the expected change in the price divided by the current price. But the difference between foreign assets and domestic assets is just that we need to convert foreign prices into the domestic currency, because we want to calculate the return in the domestic currency units. And if we take logs of this expression, then the expected return is approximately the difference in the log price plus the difference in the log exchange rate. So here you see that basically the expected return on a foreign asset depends on the two components: the change in price and the change in the exchange rates. So this is an important thing to take into account, because for domestic assets we only have the change in price, the expected change in price. What we here we also need to take into account the expected change in the exchange rate, which may be very significant, in fact. So the return, for example, if you invest in, for example, in American stocks, and you live in Russia, then obviously the second component will be even more important than the first one, because in the US, for example, the stock returns are not that high because they have quite low inflation. So the nominal returns are quite low in the US or in European ones. However, since ruble is depreciating over time, and hence the exchange rate of the asset. We also have the rate risk, which is the change in the exchange rate, the risk, the volatility of the exchange rate. And we have the country risk or political risk or country economic risk, because we invest in a foreign country and anything can happen. And also we have the liquidity risk. So here it's written separately, but it's just one more type of risk, which is the cost and speed at which you can dispose an asset, at which you can convert an asset into cash, usually measured as the market volume of an asset or the bid-ask spread if an asset is quoted at bid and ask prices. But the liquidity risk is the general risk which you consider for all types of assets, in addition to the market risk. But the exchange rate risk and the country risk, these are the two extra risks which arise if you invest in foreign assets. In general, what does the demand for foreign assets depend on? So as we said, that its main component is the expected return, right? But the expected return depends usually on the level of interest rates in that economy. So the interest rate, the local interest rate or the domestic interest rate, is the most important factor that affects demand for investments in different countries. The level of interest rate, of course, depends on many characteristics, and one of the important characteristic is the level of inflation in the economy, because we're talking here about the nominal interest rates, which affect nominal returns. And the nominal interest rate, as you remember, consists of the real interest rate, the inflation rate as a premium, and also there is a so-called inflation risk premium on top of inflation. So in economies where we have higher inflation, we usually have higher inflation risk, which is the volatility of inflation, like how inflation changes over time. So in high inflation economies, the interest rate level is usually higher. And as a result of that, all local returns on local assets are also higher, right? And in economies where the inflation rate is low, all local returns are usually also lower. And by local returns, I mean returns on all assets. So these are returns on deposits, bank deposits, which usually depend on inflation rates, stock returns, bond returns, so all types of assets. Usually their returns, I mean, if you compare returns across countries, the levels of returns are different across countries, and this difference is usually due to the different levels of the local inflation rates. And here you can see a plot of interest rates in the US and Japan. The blue line is the Japan interest rate, the yen rate. So it's the interest rate in Japan, and the red line is the interest rate in the US. And you see that historically, for many years, there was a huge gap between the interest rates. And only in the recent years, actually, they quite coincided, because the interest rates basically were around zero or even negative in Japan in the recent years. But in many previous years, the gap was significant, and this difference was mainly due to the inflation rate in the US, because in Japan we had very low inflation rate, even deflation. Here you can see that the interest rate is very low starting from 2000, because in Japan we even had deflation. They had deflation. So some interest rates are even negative in Japan. But in the US, the inflation rate was quite high in many years previously, and as a result, the interest rate was also higher. And you see, this gap is important. It's like in these years, for example, around 2000s, it's about 6%, and this is a huge gap, right? So basically, you can see straight away what should an investor do. An investor should basically borrow in yen So sell assets in Japan and buy assets in the US. And then the investor will earn this gap, basically, the 6% gap on top of the local return also. We'll talk about this in detail a lot, about this borrowing and lending strategies. It's called a carry trade. When you buy in low interest rate currencies and sell in the low interest rate currencies and buy assets in high interest rate currencies, this is called a carry trade. And we will talk about carry trades a lot in this course. Yes, there was a question in the chat. What is this interest rate? Yeah, usually when we consider this type of rates, we look at short-term treasury bills, like the government rate, not deposit rates. All deposit rates will be similar. In fact, they will be quite close, but they will have some margin on top of this rate, which usually depends on the riskiness of the bank. Yes, these are treasury bill rates, short-term treasury bill rates. Okay, so the interest rate is the most important parameter which affects expected returns on foreign assets. So now let's also have some formulas and calculate expected returns on foreign assets. So basically what we do when we have, let's say $1, and we want to invest in euro, what we usually do, we first convert into euro by the current exchange rate, which is called the spot exchange rate. Then we invest in a euro asset, for example, a euro deposit at the euro interest rate. So these proceeds are multiplied by 1 plus the return, the interest rate in euro. After one period, we convert the proceeds back into dollars using the exchange rate at that time in the future. So basically that should be the expected exchange rate. And then, so we started with dollars and then we end up with dollars again, right? And the return, our return in dollars is calculated as follows, right? So basically we repeat this exercise, and this is our final return expressed in this formula. So this formula is similar basically to this formula. Just the difference is that here we have the prices of foreign assets, and here we have returns, interest rates. But depending on what you have, you can use any of the formulas, so they're equivalent. So the return in dollars, this expression can be rewritten as follows. The return in dollars is 1 plus the interest rate or the return in euro multiplied by the difference, the ratio of the exchange rates, t plus 1 over t, and minus 1. So this expression can also be approximated using this expression. So if you open the parentheses here, you can rewrite this expression as follows. The return in dollars equals the return in euro plus the percentage exchange rate change. So this is the most common way, like formula to calculate the returns, the most widely used formula, even though it is approximate formula, so it's not exact. If you want to calculate exact returns, you should use these formulas. they give you the exact return. This formula gives you approximate returns, but it is easier to interpret this formula. So once again, the interest rate in dollars equals the interest rate in euro plus the expected change in the exchange rate between dollars and euro. So basically, when we invest in a foreign asset, we have these two components again. We have the return in the foreign currency plus the expected change in the exchange rate. We can also calculate the excess return if we subtract. So the excess return is like the extra return in the foreign currency. We can take the dollar return to the right-hand side. So the excess return is the interest rate differential plus the expected change in the exchange rate. You see that according to this expression, it should be zero. In equilibrium, like the excess return should be zero, but off equilibrium it can be positive or negative. So once again, if you invest in a foreign asset, it's quite common to look at excess returns, not nominal returns. And the excess return is the extra interest rate over the domestic interest rate, which is called the interest rate differential, or just interest differential, plus the expected exchange rate change, depreciation or appreciation. So this, of course, this can be positive or negative. And these two components are the most important, and you should always keep them in mind. That the return from investing in a foreign asset has these two components, and even though the first component is positive, the second component may be negative. It may offset the interest rate differential, or on the contrary, it may add up an extra return. So now, what is the equilibrium in the forex market? So how, like in theory, what should be the relationship between the interest rates in two economies and the exchange rates? So we have the assumption that investors care only about excess returns. So basically, in this model, we do not consider risks of investing in foreign assets. So we only consider returns. So you can think of our investors as risk neutral guys, or risks just absent in the market. Like there is no risk, everything is certain. All investors are risk neutral and they do not care about risk. So this is just the assumption, which is very important for this, in order to derive this equilibrium. So the foreign exchange market is considered to be in equilibrium. And the equilibrium basically means that there are no capital flows, that like we have stable conditions on the market. And so the foreign exchange market is in equilibrium when deposits of all currencies offer the same expected rate of return. In other words, all the excess returns are zero. In this formula, for example, so all the excess returns are zero means that this expression holds, basically. That returns in different currencies are the same when converted to the same currency. So this is also called the uncovered interest parity condition, which you all know already. Again, what does it state? That the interest rate in one currency, dollars, for example, equals the interest rate in another currency plus the expected exchange rate change. And this condition should hold for all pairs of currencies, and this is called the equilibrium in the forex market. Why is it the equilibrium? Because like if you invest in the US dollars, you get this return. If you invest in euro, in European deposits or in other European assets, you get this return, and it's the same. The expected return is the same. So for all assets, the expected returns are the same, taking into account the expected changes in the exchange rates. Then for investors, there is no sense in converting their funds from one currency to another. And as a result, we have the equilibrium. So if, for example, the right-hand side were higher than the left-hand side, then so the expected return in Europe on European assets would be higher than the expected return on dollars. Then all investors would transfer their funds to Europe, right? They would invest in European assets because of the higher expected return, and as a result, the exchange rate would adjust. Like the European currency would appreciate, the expected return on European currency would be lower as a result, if the current exchange rate depreciates. And as a result, again, we'll have equality of the right-hand side and the left-hand side. So this UIP condition is ensured by the capital flows, basically. So whenever the UIP condition is violated, we have capital flows to that country where the expected return is higher. Because investors care only about excess returns. So where the excess return is positive, they will run to that economy, to that country, and buy those assets. And this will create a pressure on the forex market, and the spot exchange rate will change. And as a result, the expected exchange rate return would also change, and we will be back to equilibrium. So the equilibrium condition in the forex market is the condition where we have no capital flows between economies, because all the returns in all economies are the same. Here, this basically equilibrium is depicted on a very simple diagram of the style of your first year economics models. So this diagram, we have the current spot exchange rate on the vertical axis, and the domestic interest rate, the domestic interest rate in dollars here. So imagine that you sit in the US. You are in the US, and you want to invest in Europe. So we have the US textbook written by US authors. That's why, like, imagine that you live in the US. You take the perspective of a US investor in this course. And this is the most common perspective because most of research and most of textbooks in this area are all written in the US for some reason. So we have the US interest rate on the horizontal axis, the spot exchange rate on the vertical axis. The vertical line is the return on dollar deposits, or return on dollar assets, which is just the interest rate. That's why it's vertical. It doesn't depend on the exchange rate. It's simply the R in dollars. And this green line is the demand schedule for foreign assets, which is the expected return on foreign deposits, so the expected return on euro deposits. And the expected return on euro deposits is this right-hand side of this expression. So it's the European interest rate plus the expected exchange rate change. current exchange rate. So this is the spot exchange rate. If it is lower, it means that we expect the expected exchange rate increase is higher. The lower is the current exchange rate, because basically this line is drawn for a given level of the expected exchange rate. So this parameter, the expected exchange rate at t+1, is exogenous here. So it is given. So it is drawn for a given expected exchange rate. So the lower is the current exchange rate, the higher is the change in the exchange rate, which is the appreciation of the foreign currency. And hence, the higher is the return. So you see, if we are moving downwards along this line, the spot exchange rate is lower, and hence the return on foreign assets is higher, which is drawn on the horizontal axis, is higher. No, this line is drawn at t, now, today, at time t. And the exchange rate at t+1 is exogenous. This is just given parameter. So whenever we have a change in the expected exchange rate, this line will shift upwards or downwards. Once again, if we move downwards along this line, you see that the current spot exchange rate is lower, and as a result, the potential return on euro deposits is higher. And obviously, the equilibrium is in point 1 when the expected return on euro deposits is the same as the expected return on dollar deposits, so there is no reason to transfer funds from one country to another. So this is the equilibrium. At point 2, why is it not an equilibrium? For example, imagine that the current spot exchange rate is this. Then at this level of exchange rate, the European deposits yield a lower return than the dollar deposits, or European assets yield lower return than the dollar assets. So all investors would basically sell European assets and buy dollar assets, right? Because the dollar assets yield higher return. And as a result, dollar will appreciate and euro will depreciate. So we'll have a movement down of the exchange rate. So the current spot exchange rate will decrease. Why is this not an equilibrium? Because at this point, we have a pressure on the Forex market, and this pressure is to reduce the exchange rate so that it becomes the equilibrium exchange rate. So here we expect dollar to appreciate and euro to depreciate. And depreciation of euro means a fall in the exchange rate. Yes, be careful here that the exchange rate, what we plot on the vertical axis, is the direct exchange rate, which is the price of foreign currencies in the domestic currency. And the domestic currency is dollars here. So the exchange rate is the price of 1 euro. You see the quotation, dollars per 1 euro. So a fall in the exchange rate means a depreciation of euro and appreciation of dollar. Why is this not an equilibrium? Point 3. Again, at this current level of exchange rate, European deposits yield a higher return than the dollar deposits. So all investors would sell dollar assets or dollar deposits and buy European assets. This would create a pressure on the Forex market again. This cannot be equilibrium because at this level, this is disequilibrium because we have like higher returns on European assets than on dollar assets. So all investors want to buy European assets, and they will, in order to buy European assets, they need to convert dollars into euro on the spot market, and hence there is an extra demand for euro, and as a result, euro will appreciate. So we'll have movement towards, again, upwards here. So the exchange rate will increase and euro will appreciate. So again, you see that at all these disequilibrium points, 2 and 3, we have pressure, we have capital flows on the Forex market, and they will move our economy towards point 1, which is the equilibrium. But I remind you again that, which is very important, that we assume that investors care only about returns, potential returns in different markets. Like there is no risk here. Because if we had different riskiness of dollar and European deposits and investors cared about this risk, then the situation could be different. In this model, there is no risk, and hence, whenever a return in one currency exceeds a return in another currency, we have capital flows, which move for the current spot exchange rates to another level. Okay. Now, so let's look at, let's play with this model. So once again, this graph depicts equilibrium in the Forex market. Now, if we have some changes of factors, what will happen? For example, if the domestic interest rate increases, we have a negative effect on the exchange rate. Why? Because if the domestic interest rate increases, this vertical line shifts to the right, and as a result, you see at the previous level of the exchange rate, we now have a disequilibrium. We now see that the US assets yield higher returns than European assets at the old level of exchange rate. So this is not good. We have capital flows to the US, and as a result, dollar will appreciate, euro will depreciate, and we will move to point 2, where we have the new equilibrium with a lower level of exchange rate. So if the return on dollars increases, we observe a fall in the exchange rate. That is a depreciation of euro and appreciation of dollars. Now, if the foreign interest rate increases, or if the expected exchange rate increases, so the expected exchange rate is the next period exchange rate, which is the exogenous parameter. So whenever any of these two increase, basically, if this increases or this increases, the return on the foreign assets increases. So this green line shifts to the right, and as a result, we again are in disequilibrium, because at all level of the exchange rate, at this level of the exchange rate, we now have disequilibrium. At this point, that the European interest rate, European return would be higher than the US return. As a result, capital flows will move to Europe. Investors would buy European assets, and euro will appreciate, will move to point 2. Okay. So now let's look at the money market, which determines the level of the interest rate. So as you have seen in these graphs, one of the most important factors which affect exchange rates is the level of interest rates in the local economy and in the foreign economy. But what affects the level of interest rates? Here we need to look at the money market. The money market is this is your like standard macroeconomic chart, where we have interest rates on the vertical axis and real money balances, real money holdings on the horizontal axis. And we have money demand and money supply. The real money supply is vertical, the money demand is a downward sloping function. And we have many factors which may affect either money supply or money demand. Yeah, so we will not repeat the macroeconomic course here. You should remember it from macro that, like, for money supply, what affects the money supply? Like the price level affects the real money supply. The monetary policy, where the central banks just expands the money supply or contracts it. And there are many factors like velocity of circulation. So whenever we have, for any reason, a shift in the real money supply in the economy, we will have a change in the local interest rate, which will in turn affect the exchange rate. For the money demand, we also have many factors. Like the most common are the real money, the real income, the interest rate, of course, depends. So the money demand, of course, depends on the interest rate in the economy, because this is the opportunity cost of holding money. It depends on the real income, which affects consumption, and as a result affects your money demand. And there are actually many other factors which may affect the demand for money. So like all money supply demand factors or money supply factors, they will all affect the interest rate in this economy. And we can plot the same chart for the domestic economy as well as for foreign economy. So any change in these factors in the domestic economy or any change in these factors in the foreign economy will all affect the corresponding interest rates. And as a result, this will affect the exchange rate. So you now already see why we have huge exchange rate volatility, because everything affects exchange rates. So now let's look at how a change in the money supply affects the exchange rate in the short run and in the long run. So we combine the two graphs together. So the top graph here is this graph, basically, this one. The Forex, this is the chart of the Forex market. The bottom graph here is the money market in the US. It's the same graph as here, but it is rotated by 90 degrees to the right, clockwise. So we just rotate this graph so that we have the interest rate axis, which was vertical. So here it should be horizontal. The interest rate is, so in this model, so the question is whether the interest rate is the deposit rate. Yeah, I use this interchangeably because in this model we do not specify what is exactly the interest rate. It's just the local interest rate. It may be the deposit rate. I mean, this is the theoretical model. In the theoretical model, we basically have one asset, one local asset, whatever it is, treasury bills, or deposit rate, or deposits, or stocks, any type of local asset. It's just one, because it's a theoretical model. But of course, when we want to test it empirically, then we need to pick the right interest rate, and we have a lot of different interest rates. And usually in this kind of analysis, we use treasury bill rates, not deposit rates. But I think in the textbook, where I took these graphs, they call it the deposit rate, just for simplicity. But usually it's not the deposit rate, and you should understand why, because different banks set different deposit rates. So the deposit rate depends on banks, on banking competition, on the riskiness of banks, and so on. So that's not the universal rate for an economy. The treasury bill rate is the more general type of short-term interest rates or risk-free rate, which is used in this analysis. So this is the treasury bill rate, to be more correct. So now we combine the two graphs in order to see the effect from the money market to the forex market. And let's trace the effect of an increase in the country's money supply on the exchange rate. Okay, so it's very simple. As we said here, that all money demand and money supply factors affect in the end exchange rates. So what happens if we have an increase in the money supply in the US, in the domestic economy? So this money supply schedule shifts to the right or downwards in this case. As a result, the interest rate in the US falls, right? We have an expansionary monetary policy. So this is what usually the US government is doing in order to stimulate the economy. For example, during coronavirus pandemic, when it started in spring, the Fed, the Federal Reserve Bank, which is like the main monetary authority in the US, it decreased the interest rates. And I think the same was done in Russia and in most countries, actually. So there was an expansionary monetary policy in order to stimulate the economy. So in this case, the US interest rate falls, right? We move to 0.2, but assume that in other countries nothing changed. So the dollar return decreased. We have a shift to the left of this schedule because like the interest rate was this, now it's this. And as a result, the exchange rate should increase, or in other words, European currency should appreciate. Why? What is the intuition behind? Like if there was an expansionary monetary policy in the US, the US assets provide lower returns than the European assets, because nothing changed in Europe, but in the US the returns fell. So all investors rushed to Europe to invest in European assets. As a result, they sold dollar assets, they sold dollars, they bought euro in order to buy European assets, and euro appreciated. So we moved to 0.2. This is like this is called the short run effect, the appreciation of euro. But now, if we want to consider a long run effect, now we need to determine whether this is a permanent or a temporary increase in the money supply. If it's a permanent increase in the money supply, then basically we know that in the end, due to this money neutrality, an increase in the money supply would just mean an increase in general price level, right? So in the long run, when prices adjust, they will just increase. We'll have inflation and nothing else. All real variables will return to the initial levels. So this is the money neutrality concept. So if we had a permanent increase in the money supply, then we also expect the price levels to increase, and hence we expect dollar to depreciate in the end, simply because of the price level in the long run. So what we will have is a bit different picture than this. So in addition to this effect, we will also have a shift in the green line, because basically, so not only orange line shifted to the left, like the dollar return decreased. But also, if we know that this is a permanent increase in the money supply and all prices in the economy will increase in the end, and we know that dollar will depreciate, euro will appreciate, so the expected return on European assets will increase in the end. So in this formula, we also have an increase in this component in the long run. That in the long run, we'll have an extra return on European assets from this part, from the change in the exchange rate. But this will, in turn, shift this schedule, and instead of ending up in point 3, as here point 2 is the same as point 3. Instead of this, we end up at point 2, because the orange line shifted to the left and the green line shifted upwards, and as a result, our exchange rate increased more, even further than to point 3. So we had like a double effect on the exchange rate, because one effect is from the reduction in the local interest rates, and the other effect is from the expectations on the change in the exchange rates. So we have a more significant appreciation of euro in the short run, in point 2. But then in the long run, what happens is that the prices start to adjust, and usually because the prices are sticky in the economy, they adjust slowly, right? And when prices adjust, real money supply decreases, because the real money supply is M over P, right? Is money supply nominal divided by the price level. And as price level increases gradually, M over P decreases. So this line starts to shift backwards or upwards. So we move along this money demand curve, basically backwards. So in the end, the real interest rate in the economy, in the US economy, will move backwards. So initially decrease, but then it will increase backwards. Because we know that in the end, in the long run, the real interest rate stays the same, because all real variables stay the same according to the money neutrality. So, but this movement will be gradual. And on the Forex market, what will be happening? So when the prices start to adjust, the US interest rate starts to increase. And when it is increasing, this orange line shifts to the right gradually. And we move basically from point 2 to point 4. But notice that point 4 is already, it is on the new green line, because like the expectation is not changing now. So whenever we had a change in the expected exchange rate, the green line shifted, and now it stays on the same level. So we have movement along the green line to point 4. And this would be the final equilibrium exchange rate. And you see that point 4 is above point 1. Obviously, you can see it on this graph better. So it is here. So what happened to the exchange rate? In the short run, the exchange rate increased from point 1 to point 2. And in the long run, it slowly adjusted to point 4 here. And this is an example of an exchange rate overshooting effect. You have probably heard about the overshooting model, right? It's this model of exchange rate overshooting, which arises because of a change in the money supply, a permanent change in the money supply. These graphs show the time trends for different variables. So the money supply was initially this, then it jumped and stayed on the new level. So we had a permanent increase in money supply. What happened in the dollar interest rate? It first decreased from 0.1 to 0.2, but then it moved gradually to the initial level because in the long run, the real interest rate should be the same. Then the price level was initially this level, but then like after we had an expansionary monetary policy, it started to adjust slowly and it adjusted to the new level gradually. And the exchange rate was initially this, E1. Then in the short run, when we had the money supply increase, it jumped to E2. And then it gradually adjusted to the new level E3. So this was the overshooting case. And this graph shows you just the historical plot of the US-Japan exchange rate over time for many years. So you see like almost 30 years of data. The red line is the exchange rate change, and you see the huge volatility here, whereas the blue line here is the price level ratio change. So that's the price level in the US over price level in Japan. So they change in this ratio. You see that the volatility of the price ratio is very low compared to the exchange rate volatility. And this is just an illustration. It shows the general concept that exchange rates are very volatile compared to all macroeconomic variables. You can plot different types of variables, interest rates, real incomes, whatever. You will see that the macroeconomic variables have very low volatility over time, but exchange rates and in general all financial variables have very high volatility. Like stock prices also have very high volatility. If you look at cryptocurrency market, which I'm studying right now, there is huge volatility, even compared to the exchange rates. The volatility of the cryptocurrency market is many times more. But in this course, we talk about regular currencies, not cryptocurrencies, but even they have quite high volatility compared to macro variables. And where does this volatility come from? So it partially comes from exchange rate overshooting, which is an absolutely rational phenomena which comes out from the theoretical model. Just because we have the change in the interest rates and change in expectations at the same time. So both effects exacerbate the effect of the money supply and exchange rates, but then we have the correction. So this is the overshooting. We also have an overreaction in the investor overreaction, which is even on top of overshooting. Overreaction is a non-rational phenomenon. So whereas overshooting is a rational, comes out reaction is just the behavioral stuff. So investors tend to overreact to news. When we have if the central bank announces an expansionary monetary policy, investors will run to the market, sell and buy foreign currencies, and as a result, the exchange rate will be pushed even further from the equilibrium, from the true fundamental value. So this is called overreaction. It's absolutely irrational, but it exists in financial markets, especially in markets where we have a lot of individual investors or investors who are prone to these behavioral biases. But anyways, so there is huge volatility in the forex market, which is depicted by this graph. And it is partially explained by the overshooting model, but not to the full extent. So what else affects the exchange rate? You can trace the effect on the exchange rate from any variable using this kind of analysis. And in some cases, there is overreaction and overshooting. In other cases, there is no overshooting. But in most cases, there is. And you will have such problems in the classes where you need to trace the effect of some variable on the of some changes in some macroeconomic variables on the exchange rates in the short run and in the long run. So if we have changes in inflation differential, that is, if we have changes in the domestic inflation or in foreign inflation, this will affect the exchange rates. Then changes in interest differential. So these are changes in local interest rates or foreign interest rates. Again, will affect the exchange rate. Changes in income differential. So this is the change in domestic income or the change in foreign income. The change in real income affects the money demand schedule in the respective country. As a result, the money demand schedule affects the interest rate, and the interest rate affects the exchange rate. So you can trace these effects in this model. Government controls, again, different limits or controls of capital flows or abandonment of such controls. This will all affect the exchange rates. Expectations regarding future exchange rates. This is also like an exogenous factor in this model, and these expectations, if they change for some reasons, like there are some news coming out about one economy or the other economy, this news will affect expectations, and as a result, expectations will shift this green schedule, and as a result, we'll have a change in the exchange, in the current exchange rate as well. This is another chart from the textbook, which also shows you different channels, like what factors may affect exchange rates. So here the factors are classified into trade-related factors, like factors which affect current account. So as we said already, inflation differential, income differential, government trade restrictions, they affect the demand and supply of foreign goods. So they also affect net exports. As a result, they affect the demand and supply for foreign currencies, and they affect the exchange rate. Then there are factors which affect capital account. The interest rate differential, capital flow restrictions. Actually, the inflation differential should be here as well. But if it's the interest rate differential, it already incorporates the inflation differential because we are talking about the nominal interest rates here. Or you can separate the effect of inflation and real interest rate differential. But anyways, so these factors, interest rate differential and capital flow restrictions, affect the demand and supply of foreign securities and the domestic securities on the side of foreigners. And they affect, in turn, again, the demand and supply for foreign currencies and the current exchange rate. This was kind of a macroeconomic type model, which basically helps to trace the effects of different variables on the exchange rates. Now let's talk about the forward exchange rate and how it is determined. So far we talked about the spot exchange rate, so the current spot exchange rate. The forward exchange rate, as you remember, is the exchange rates which is fixed in forward or future contracts. And this is the exchange rate for delayed transactions. So even though it is set today, but it is valid for future transactions on a given date in the future. The forward exchange rate is not determined in the equilibrium condition as the spot exchange rate, but rather it is determined in the no arbitrage condition. We already studied this stuff in financial economics course, so let's just quickly remind you this stuff. How to determine the forward exchange rate? We can generally consider two strategies. Like, again, we start with $1 and we have a dollar-euro exchange rate. So what we can do, we can invest this dollar in a dollar deposit, or not deposit, just dollar treasury bill, doesn't matter. So the return from this strategy after one period, the total return after one period would be 1 plus the interest rate in dollars. This is the gross return. Or we can convert the same dollar into euro at the spot exchange rate, invest it in a euro deposit or European treasury bill, or we can buy a European treasury bill, and then we can sell it after one period and convert the proceeds back into dollars, but using the forward contract. So we do not convert the proceeds backwards on the spot market at the next period. However, we already now signed the forward contract to convert the proceeds backwards. So we do not have the risk here. We basically fix the exchange rate for this conversion backwards. We fix it today. So the return on this second strategy is this one, right? So we have $1. We divide it by the exchange rate. This is the proceeds. We multiply by 1 plus the European interest rate, and then we multiply by the forward rate to convert these proceeds backwards. And the two strategies start with $1, so they should end up. Again, the two strategies are risk-free. They start with $1, so for no arbitrage condition, they should yield the same amount of money in the end. That's why we equate the proceeds from the first strategy to the second strategy. So we can rewrite this expression as follows, that the forward rate is the spot rate multiplied by the ratio of the interest rates. This is called the covered interest parity condition. You know it, right? Why is it covered? Because it is covered by the forward contract. We do not have the exchange rate risk here. The conversion into euro is done at the current spot price, which is known, and the conversion back into dollars is also done at the forward price, which is known now. So there is no risk. So this is one way how we can write down the covered interest parity condition. This is the exact condition. We can write it in the approximate form as follows. That so we had similar forms for the uncovered interest parity on the previous slides, and these are the forms for the covered interest parity. So the approximate CIP is that the interest rate in dollars equals the interest rate in euro plus the expected change. So sorry, this is not the expected change because we have the forward rate here. This is the this is called the forward premium, basically. The forward premium is the difference between the forward rate and the current spot rate as a percentage of the current spot rate. If we use forward contracts in this kind of strategies, then the return on foreign assets is the foreign interest rate plus the forward premium. Again, this is the approximate CIP. So we get the return from the foreign interest rate and we get some extra return from the foreign premium, or it may be negative. The foreign premium may offset this return. So it depends on the level of interest rates. Or we can rewrite the CIP condition as this one, where on the left-hand side we put the interest rate differential, and on the right-hand side we put the forward premium. So all these forms are used in different papers or textbooks, and you should know them. So this is the exact CIP, and these two are just two ways of writing the approximate CIP condition. This condition shows how the forward exchange rate is determined. So we need to have this equality, and this equality, so the interest rate differential equals the forward premium, and this is how the forward exchange rate is determined. So this equality, keep in mind that this is not an equilibrium condition, it is rather no arbitrage condition. So this is the condition when there are no arbitrage profits between these two strategies. So basically forward contracts should price following this condition, because otherwise, if the forward exchange rate deviates from this rate, so we have inequality here, then we would have arbitrage opportunities. And arbitrage opportunities would ensure that, so basically, our arbitrageur would buy the cheapest strategy out of these two and sell the more expensive strategy, and would earn the difference as profit. This would be called the arbitrage profit. But these actions of arbitrageur will move the forward prices towards this equilibrium condition, this no arbitrage condition. So in the long run, it should hold this no arbitrage condition. Like it cannot, we cannot observe this inequality here consistently over time, because like there should be a reason why, if we observe an inequality here, then there should be a reason, some very strong obstacles to arbitrage, which would not allow the investors to make profit out of this arbitrage strategy. So in general, when there are no such obstacles to arbitrage, then this condition holds, the equality condition. So the CIP, we'll talk a little bit research, but just to preview the results, the CIP condition generally holds on the foreign exchange market. So this equation generally holds, indeed, empirically. So this is just a roundup. So we have studied the covered and uncovered interest parity conditions, and these are the two most important formulas in the whole course, and we will return to these formulas all the time when we study different currency trading models, or exchange rate determination in the long run, or theoretical models of exchange rate determination, or empirical models of investment strategies. We'll return to these conditions because they are like benchmarks. So the covered interest parity condition has the forward rate here. The uncovered interest parity condition has the expected spot exchange rate here. The forward rate is known in advance at time t. This rate is not known at time t, so it needs to be forecasted. The CIP condition is the no arbitrage condition, whereas the UIP condition is just the equilibrium condition when we do not have capital flows between different currencies. But this UIP condition should hold under the assumption that the investors are risk neutral, or if we do not have any risk in the economy. okay, which is obviously not true in real life. So the UIP condition is a very theoretical condition which holds an ideal economy without risk. If the two conditions hold, then you can see from these formulas that the forward rate should be equal to the expected exchange rate. So we can see that the forward rate is a good forecaster of the expected, of the true spot exchange rate in the future. But this is only true when that the forward rate is a good forecast of exchange rate, of the future exchange rate, but this is only true if the two conditions hold. So we can equate this right-hand side to this right-hand side, because the left-hand side is the same. However, if they do not hold, if any of them do not hold, then there is no equality anymore between the forward rate and the expected exchange rate for the future. And this is actually what we observe empirically. Empirically, we observe that the CIP condition holds, whereas UIP condition doesn't hold. And as a result, the forward rate is not the same as the expected exchange rate in the future. Why this happens is because of the risk, exchange rate risk. So this UIP condition is derived in a macroeconomic risk-free model. But when we incorporate risk into this model, then the UIP condition will not hold anymore, because some currencies will be more risky than other currencies, or like treasury bills in one country will be more risky than treasury bills in another country. So the expected return would not be the only factor for investors, and the risks would play an important role, and the risks may prevent from this equation from equality. Once these forward rates are not equal to the spot exchange rates, this gives us opportunity to trade, to form investment strategies, different investment strategies, and earn positive excess returns on these strategies systematically over time. So we'll talk about this stuff in the next several lectures about these investment strategies. But the reason why these investment strategies work is mainly because the UIP condition doesn't hold. That the whole this model, macroeconomic type model, is not completely true actually, empirically, in real life, because we have risks. So this is the main difference between your macroeconomic course and the international finance course. In your macro course, you do not have risk usually. And the international finance course, because it's finance, it's about risks. And risks play a very important role, the most important role in asset pricing. They determine prices of all assets, mostly. So risks should be taken into account. Okay, so there is one more slide, but we'll talk about this in the next lecture. How we can make money on deviations from equilibrium conditions. And then we'll proceed to investment strategies. Okay, guys, I hope you're still here. Sorry, I was muted. Okay, so let's finish now. If you have any questions, you may ask. I think the slides are already uploaded in the Google folder. I sent you the link to the Google folder, so the slides should be there. I remind you that the next class will be next Wednesday, and And the quiz will cover this material, like this, the exchange rate overshooting model, and basically the exchange rate determination models, and the basic stuff from the previous lecture. Okay, if you do not have any questions, then we can stop here. Okay, great. I do not see any questions. So guys, you can always ask questions in the Telegram chat.
Можно маленький буквально вопросик. По поводу вот онлайн-лекций. Не могли бы вы напомнить, где их можно посмотреть? Я прослушал немного.
Да, я на Google Диск скидывала программу курса, ну, syllabus, и там есть ссылка на вот эти онлайн-лекции.
Окей, спасибо.
Okay, guys. So see you next week then. Bye-bye.